Hi, this is Phil Edholm again. Welcome to the third video in the UCStrategies UC Benefits and ROI Analysis tool. In this video, we're going to focus on the results of the benefit data entry we did in Training 2. We'll then look at how to enter costs for the system, the pricing, using the Pricing tab, and we'll close with looking at the three financial analysis that the tool does. The ROI or cash flow analysis, the P&L or depreciation analysis, and finally the comparison to the existing telephony solution for a PBX replacement. Here you see the times when each of the specific chapters starts. So for example, about 6 minutes and 30 seconds into this video, you'll see the beginning of the ROI analysis discussion. So you can jump forward to the right time. In the last video, we looked at how to enter the benefit data. As we begin looking at the financial results and financial analysis, I'd look very quickly at the benefit values and how they actually display. Now these are actually shown in the report, but they're also shown here on the benefit value tab. So again, we enter the benefits here on the benefit tab, and you can see the benefit values. Now we look on the benefit value, the results tabs, and we actually see here, these are the annual benefits. Now you notice 2013 is relatively low. That's because our installation date is relatively late in the year. And then 2014 to 2018 grows, and that's based on the number of users and the percentage of UC use increasing over those years. And you can see here right below, it has the SIP trunking values. You can see the big annual value is in fact in collaboration, that big collaboration impact. Now the next, to scroll down a little bit lower in this tab, we actually see that this is the cumulative savings over the course of the 6 years. So you actually see that it adds up here into a total of over $2.5 million over the 6-year period. So this is actually the benefits. Now let's go on and look at system pricing. Now that we have the benefits of our UC system identified, the other side is the cost. So the UC system pricing tab actually develops the pricing in one of two ways. Either by a set of parameters within the tool, which your product management team can optimize to your organization's delivery, or by actually entering a specific quotation for the customer. So what you see here is at the top, the premise deployment pricing. A little bit lower down, we'll see cloud pricing. So this is the deployment price. Now remember, we only had 200 users. And so the assumption here is that this 200 user core, there's a fairly expensive core set of prices, but these are the core UC pricing, the licenses, the replacement peripherals pricing, and you can either leave these as estimated by the tool, or you can replace them. Let's say, there's a special, this can be done for $20,000 instead. You can just enter $20,000 there as the number. Then the total here is the total install pricing, including network upgrade and consultant fees. And what you'll notice is that this is actually the price per seat. Now this looks relatively high, but that's because, remember, of our 550 users, only 200 were actually on the premise. So it's a fairly expensive solution for those small number of users on the premise for a typical complete UC solution. Now as you go down through the rest of this tab, you actually have the pricing for beyond the initial install year of 2013. So this is future expansions pricing. So pricing for all the components of expansion every year based on our growth that was actually built into the model. Then if we go down a little bit farther, we see ongoing premise operational pricing. This is internal labor rates. Same kind of factors as before, a 45% burden, assuming a $53,000 set base salary here, $72,000 with burden. You can enter an actual amount if you want. And this 2% actual increase is what's calculated into the tool to be used every year through the years of installation. Then basically the other factors of ongoing support: vendor software support, Mac and maintenance, operational staff headcount, the result of the headcount cost based on the numbers above, ongoing network bandwidth pricing. So if there's going to be additional cost for network bandwidth, that needs to be built into the ROI analysis. And finally, energy and real estate pricing. If we go down a little bit farther here, we see that the rest of this is cloud deployment pricing. So here's cloud deployment pricing, annual cloud subscriptions, based on the subscriptions that were specified. And then what is the cloud premise equipment that's required? So peripherals, in an augmentation model, it would be integration with the PBX. Survivability equipment, things that are designed to let the system continue to work if internet connectivity is lost. Installation and training, and network upgrades again. So essentially this all comes together in a view of what is the premise costs, the cloud costs, and the total cost of the solution. At the bottom of this tab, there are some graphs that actually graph this out and show you the cost. You can see here the high premise cost in the install year. This is a cash flow analysis, and a relatively low cloud cost because it's only part of the year. Then the cloud costs are actually higher in the out years than the maintenance of the premise equipment. So, and then you see cumulative cost basis of the entire system, the first year, the large installation expenses, and then in the out years. Now, notice that these cost models do not show depreciation impact. We'll actually see that in the financial analysis next. The next part of the tool is the return on investment analysis. And you'll actually notice that the tabs, there's an ROI analysis tab and a P&L analysis tab. These are actually two different financial analyses that are done, and enables your customer to look at whichever is most appropriate for their business. The ROI analysis is a cash flow based analysis. So it basically represents cash as an in-period expense in all cases. So for example, if we install a system and it costs $500,000 to install it, that entire $500,000 is shown as a cost in year one. The P&L analysis, or a financial analysis, or a depreciation analysis, those are different phrases that may be used, actually depreciates that purchased asset over an extended period of time. This is normal in accounting processes, procedures to do that. So for example, let's say we have a system where there's a $700,000 initial purchase and installation. In a cash model, that entire $700,000 will be treated as an expense in the first year. So a negative $700,000 of impact. In a depreciation or P&L model, that $700,000 might be depreciated over 7 years at $100,000 a year. So the impact in the first year is only $100,000. So what you see on this page up at the top is you see the capability of include or exclude any of the benefits. So you can, for example, click here and exclude our SIP trunking benefit. And you'll notice down here the cash flow or the cash flow and depreciation, ROI, and potentially the break-even point will change when you do that. So that's actually the output of this part of the tool, is a real analysis of the financial impact. So the first thing is the calculated return on investment over the 6-year analyzed period. So what percentage did the investment return over that period? And what you see is that it actually returned over the original investment in that 6-year period by a significant percentage, 116% return on investment. The payback period is when we actually reach break even. And you'll notice that the cash flow payback period for this analysis is about 10 months, where the depreciation cash flow is about 6.7 months. And the reason for that is that in the depreciation model, you actually move those expenses out, so you reach essentially a break even more quickly. And you can also notice that because, as you'll see on the next slide, the depreciation time frame is set for 7 years, the depreciation is a slightly better return on investment than cash flow. If we made depreciation 5 years, the amortization cycle, it would actually be exactly the same. The rest of this page really focuses on some graphs that show you what the UC cost is in blue. It's shown as negative. All costs are shown as negative here, which is traditional in an accounting practice. The benefits are shown as positive in red, and the green is the TCO, the total return on the investment, so the ROI or TCO. And so if you look here, what you notice is in year one, we actually have a cost which is running up almost to $200,000. But in year two, we actually have come to the point where year two, we're well over $200,000 to the good. So that means at some point in year 2 we would break even. Because this analysis actually started at the end of 2013, that time frame is actually, as you see up here, 10 months from the original original installation completion. The second part of this is actually the cumulative, which shows us the cumulative cash flow and positive value. So you see the cost, the benefit, and the result. So this is actually showing a significant cash value to the company. Next, let's look at the P&L, or financial or depreciation analysis. And what you see is exactly the same thing. The capability at the top to have included or excluded. These are actually controlled from the ROI analysis. So that actually sets this for all of these analyses together. So ROI analysis, P&L analysis, and the current solution comparison all use the ROI analysis settings, at the top on ROI analysis in terms of whether it's to be included or excluded. So if we exclude it here, you'll notice that it also excludes it here on the P&L analysis. Similarly, if we go back over here and include it, when we come back over to the P&L analysis, we'll find it's been included. The tool also tells you how much of the investment is capitalized. We've estimated here that all of the initial costs are essentially capitalized, but if your customer has a specific set of accounting rules that require them to exclude some of that initial cost, you can actually enter the actual capitalized amount. The next two things you enter are the amortization period for the capital. So this is the depreciation time. Here it's been entered as 7 years. And then what the company wants to get is an internal rate of return on the undepreciated asset. So internal rate of return says, if I buy something that costs $100, how much do I want to charge you for using that asset? And that's actually built into the model before the return on investment. So the return on investment includes cash costs of money in this model. What we show then next is the financial business model, which is a P&L model that shows income at the top from the different, income essentially is from the different benefits, and costs are the cost of operating the system. So what you see here is in the first year, there's actually a $21,000 loss, because actually, again, we're only applying the depreciated value in the first year, but in the second year, we actually have a $252,000 profit from the use of the system. And essentially then that continues down to show you the depreciation and payback period. These are exactly the same as you saw in the previous for the depreciation model here and the cash flow model here. You notice the cash flow model is longer. And then similar to in the ROI cash flow, we show graphs. So you'll notice that in this case, where on the cash flow in the first year, the cost was very high because all of those costs, here it's only the depreciated costs. However, what you'll notice if you actually use the tool is by the time you get to this year, they're actually generally very similar. The next tab is the current solution comparison. Now, this tab was only available in a PBX replacement analysis. If you do a PBS augmentation analysis, while this tab will still be visible as a tab, when you come to it, you'll actually find that most of the tab will not be visible because it will tell you it's not available because it's an augmentation. So this only applies, and what this is intended to analyze is there's an existing cost for operating the telephony system. If we take that into account in our analysis, what is the resulting impact of the UC investment? So again, as in the previous tabs, the include excludes are put on the ROI analysis. So if you want to change your include excludes just for this analysis, you can do it there. Similarly, there's the capitalized investment, as we had before, where you can choose how much of the capitalized cost is going to be capitalized. This typically would be the same as on the previous financial analysis. The next section of the tool actually is used to predict the cost of the existing telephony system. So you'll notice that there are a number of fields here you can enter. Some are actually calculated. At the top here is actually a calculation for remaining capital asset. And you notice that there's no capital asset data shown here. But for example, if the existing telephony system still had asset value on the books, you can put that value here for example, as $100,000. And the tool will actually calculate the year's remaining depreciation and the remaining depreciation to be written off if you replace that asset, because accounting rules require us to, if we replace an asset, to write it off. Now, one thing that's important, by the way, is that asset value, if your customer decides that they have asset value, you should deduct from the asset value on the books any salvage/recovery value of the sale of the asset. So, for example, if your customer spent $1 million for a system and there's still $100,000 of undepreciated, unamortized asset on their books, if they can sell that $1 million investment for 10 cents on the dollar and get $100,000, then there is no asset to be written off. If they can only sell the existing asset for $50,000, then the difference between the sale and the $100,000 of asset value of $50,000 is what you would put here. Now, the next part is actually, and I'm going to go ahead and take this out for our analysis right now, if the rest of this is actually the estimated cost for operating the existing system for the existing number of users and keeping it versus operating the new system. So this is the operating costs based on 2013 values. So this is, the staff headcount. There's one headcount because of the number of users. You can enter an actual amount. There's an estimated staff cost. Again, that was taken from the previous cost slide that we went through a couple of tabs ago. Actual vendor support costs, estimated maintenance costs, and actual annual energy costs. At the bottom here we have the total estimated cost, the 6-year estimated cost of current operations, and the annual cost per user over those 6 years. So you actually see what the cost is there. Now, this is then used to do an analysis comparing the new installation with and without UC benefits to the existing solution. And it actually shows you this is a comparison of average cost. So this takes the total cost over the analyzed period, 6 years, somewhere between 5 and 6 years, depending upon the time of installation, and actually calculates the annual costs by dividing that by the number of years and months it was actually used. And so what you actually see here is either an increase or savings versus the existing system. So you see that using both the cash flow and depreciation analysis, there's an increase versus the existing system for a UC solution of about $90,000 a year. But when we take into account the UC benefits, the savings are actually $380,000 a year. So when we actually add the fact that total savings in, this actually becomes a great value. As we scroll down a little bit farther in this tab, you see the same depreciation and cash flow as in the ROI tab, just put there for reference, and then a complete financial business model comparing the current system, which you can see starting, because again, the proration, $33,000 in 2013, going at about $135,000 to $152,000 because of, again, that growth. So there is some expansion there and some purchase of additional equipment. And then the new UC system, which you can see is more expensive in the initial year and more expensive in each of the out years. But then there are the UC benefits. So finally, this is all graphed, and these are the graphs that are in the report. So when you get a report printed out, you'll actually see these graphs. And this is a annual P&L comparison. So this is that annual, and it's a P&L, so it includes depreciation with and without benefits. So what you see here is the cost in blue of the current system, the cost in red of the new UC system without benefits, and the new UC system cost with benefits. But you see in the first year, there actually are costs even with the benefits. But then in the second year, what you see is the existing system cost, the new system cost, and the benefits. From a P&L perspective, the actual impact on the company is from this negative number of about $130,000 all the way up to this positive number of about $250,000. So in other words, $130 plus 250 is 387. In fact, these purple dots show the net P&L impact to the company of acquiring a UC system. And then this is the cumulative. So what you see is for this company, over the 6 years through 2018, acquiring a UC system actually will generate 2.2, almost $2.3 million of additional profit for the company. And then at the bottom, the same analysis is done as a cash flow analysis, where you see, again, much worse in the first year, but you see the same returns, a slightly lower return out here, again, because of the 7-year depreciation. Well, that concludes our third video. I hope with this training you'll be able to use the tool and effectively help your customers understand how UC can transform their business. Please join us for the fourth video in the series, which talks about how to sell and position UC benefits, both hard and soft, with your customer to actually have them implement UC and take advantage of the benefits it can deliver. Look forward to seeing you then.